Hello and welcome everyone. Today I plan to discuss some multiple choice questions on transfer pricing. Remember, this is a common topic. It's also there in ACCA performance management and it is also there in CMA US part 1. Concept remains the same that I had discussed in an earlier video. Link I will put in the comment section for that as well. So, just a brief recap because I expect most of you have forgotten about it. The rule says, the rule is very simple and says that transfer pricing means transfer between one division and another division of the same company. So both are part of the same company and the transfer is happening. The rule always says that transfer should happen always, no exception to this rule, at relevant cost. Relevant cost means variable cost of manufacturing, because variable cost generally includes out of pocket expenses to manufacture the product. So it is generally always a relevant cost. In your syllabus, generally direct material, direct labor, and variable overheads, that is indirect material and indirect labor is considered as variable cost. Direct expense is also there, but there is not a single example in your syllabus for that. So first, you always generally the transfer should be done at relevant cost, and the first relevant cost is always variable cost of manufacturing. Second, what we have is any avoidable fixed cost. That is fixed cost which would otherwise not be incurred if not for this decision. Any extra fixed cost that I am incurring because of this decision. And next, always we have opportunity cost, that is the benefit foregone when choosing one course of action among multiple courses of action. So this is the first concept. Any sunk cost, committed fixed cost is, or any other cost which is same in all the available alternatives, is always ignored while calculating for relevant cost, because those three, sunk cost, committed fixed cost, and any cost that is same in all the available alternatives is treated as irrelevant cost. So the transfer should always be done at relevant cost of manufacturing. Sorry for some screen troubles. Question number 1. A company's senior management has determined that the actual full cost will be used to determine the transfer price for goods sold from one division to another division. The selling division has excess capacity. What does excess capacity mean? Spare capacity. And it can sell goods to other divisions. Other divisions means maybe within the company or to outside customers also at a higher price. An advantage of this transfer pricing model is what? First of all, understand the question. Without understanding the question, solving the or finding the right answer is not possible. Company senior management has determined. So company senior management has decided that the transfer price from one department to another department will be actual full cost. What is actual full cost? Variable cost plus any committed fixed cost. So I'm charging variable cost also and allocated fixed cost also. This is not a negotiated transfer pricing. They have decided what will be the price. Now, this is fine. The selling division has excess capacity, means they have spare capacity. In this case, the relevant cost should only be variable cost because avoidable fixed cost will not be incurred. Opportunity cost is not there. So whatever management has fixed is little more only because they are getting full cost. Allocated fixed cost will also be recovered. But the thing is, this division can sell the same product to other divisions of the company or to outside customers at a higher price. So understand, let's say this is the situation. There is a selling division A, there is a buying division B. Now, selling division, that is A, has excess capacity. So let's say their capacity is 5,000 units. Right now, they are manufacturing only 4,000 units. That is the thing. They have excess capacity. And let's say their variable cost per unit is $5 and allocated fixed cost per unit equals to $2. So in this case, because they have excess capacity, the product or the relevant cost for transfer is anyways $5 because it should be variable cost. But management has decided that it will be full cost, that is $5 and allocated fixed cost $2, $7. It is good for the company only. But the problem is this division can sell it to outside customers maybe at $9 and also to customers within the company, that is other divisions, at $9. So it will feel that there is a problem with this decision making. Now they are asking advantage of this transfer pricing model. Disadvantage to full, but they are asking advantage. So three are disadvantages. I have to look for the odd one out. Motivates management to achieve cost effectiveness, means motivates management to control the cost. Now tell me, if I can sell it to outside customers at $9 and you are forcing me to sell at full cost, 5 plus 2, 7, why will I try to control cost? Let it be $7 or $7.50 or $8. Buying division has to pay for it. There is no motivation for me to control cost. So this is a disadvantage and not an advantage. Is effective for performance evaluation. Remember, most of the companies have autonomy, profit centers, the divisions operate. So this is not effective for performance evaluation because you are giving me $7. Okay, I have excess capacity, but I could have sold it for $9. So you are taking some profit away from me and transferring it to buying division. How is this fully fair? No. Preserves each division's autonomy. Autonomy means independence. No, independence is not preserved. Senior management has already decided the price. So A, B, C, all are wrong. D has to be the answer. Achieve goal congruence within the company. Yes. Generally, in transfer pricing questions, anyways, goal congruence is a very commonly used word. बहुत सारे आंसर होंगे that will be goal congruence. But the fact is, because this is a pure theory question, try to eliminate the wrong options out. When I say that, okay, I have excess capacity, fine. Variable cost is the relevant cost. But I could have sold it more than total cost to divisions within the company or outside customers. Then in that case, you are not motivating me to control cost because Let it be $7, $8, everything will be paid by the purchasing department only. It is not effective for performance evaluation because I'm getting less profits or no profits if I consider allocated cost. Autonomy is not preserved. You are making the decision on my behalf. Only goal congruence you can say is achieved. Sorry, there is some problem I think with my laptop today. But don't worry, I'll solve properly only the questions. Maybe for a few minutes it will feel like the old Doordarshan thing. Screen is zapping a little. Companies with decentralized autonomous divisions. So there are companies, decentralized autonomous divisions, and that is most common where companies can make their own decisions that sell their goods and services internally to other divisions of the company as well as externally in competitive markets have to establish transfer prices for the goods and services transferred internally among divisions. They are telling in the first three lines that companies where a lot of autonomous divisions are operating, who are also selling the goods to outside customers and also selling the goods to internal departments. They have to decide the price for internal transfer because for outside transfers, the price is already fixed. That is market price. They are after that saying generally, comma, upper management has established. So generally, your upper management gives this operating criteria for managing the divisions as goal congruence, subunit autonomy, and a sustained high level of management effort. They are saying generally upper management has established a criteria where divisions can be managed effectively, goal congruence is there, autonomy is preserved, and high management effort happens. What should be done? They are telling full cost per unit incurred to the point of transfer plus a percentage markup. So they are telling full cost, whatever I have incurred, variable cost plus allocated fixed cost and some markup on that cost. Okay, I am earning some profit. Okay. Additional outlay cost per unit incurred to the point of transfer plus the opportunity cost. They are telling you can also fix at variable cost plus opportunity cost. So if there is no excess capacity, means I will have to supply to other divisions by cutting down the external sales. In that case, this is a correct approach. Variable cost plus opportunity cost of lost sales. Additional outlay cost means variable cost means the additional out of pocket expenses that will be incurred. Additional outlay cost per unit incurred to the point of transfer plus the opportunity cost per unit to the buying division. No, no. Opportunity cost is always considered for the division that is selling, that is supplying. It cannot be considered for the buying division. C is not a correct answer. Not at all. Additional outlay cost per unit essentially means out of pocket expenses, that is variable cost per unit. But opportunity cost is never considered from the point of view of buyer. It's always considered from the point of view of seller. So that makes this option wrong. Option D, variable cost per unit incurred to the point of transfer. No. Variable cost only works if there is no excess capacity at all, and the question is not telling this at all. So let's assume there is no excess capacity. So C and D cannot be your right answer. Answer has to be between A and B. A says full cost plus some markup. So let's say full cost is $10, 10% markup, 10 plus 1, $11. B says market price because additional outlay cost per unit incurred to the point of transfer. This means variable cost of manufacturing, out of pocket expenses, or any variable cost, any other variable cost. Opportunity cost per unit means benefit of lost sales. If there is no opportunity cost, I will not get any. If there is opportunity cost, I will get. So this should be the most appropriate answer. See, the logic is very simple. The question is again telling, let's say A is a selling division and B is a buying division. They are telling management wants to establish a price that is goal congruent also and achieves the division autonomy also. In this case, what is the most appropriate price? We always say relevant cost. In this case, the most appropriate transfer price should always be relevant cost. Option A was telling it should be full cost per unit plus a markup. Full cost per unit means variable cost plus allocated fixed cost. This is your full cost. And on this, you will add some profit, 10%, 20%, whatever. Option C said that additional cost or additional outlay cost per unit to the transfer. This means variable cost, but opportunity cost they said for the buying division. Buying division has no opportunity cost. Opportunity cost is always considered from the point of view of seller. D is wrong because only variable cost you cannot consider. Relevant cost should be variable cost plus avoidable fixed cost plus opportunity cost. So B makes more sense because it says variable cost plus whatever is your opportunity cost. So this is the closest definition to the relevant cost, and that is why this is the correct answer. Question 3. It says division A of a company is currently operating at 50% capacity. So there is a company and their division A is currently operating at 50% capacity. So if the capacity is 10,000 units, they are only making 5,000 units. It produces a single product. Only one product is produced by them. And they sell all their production to outside customers for $13 per unit. So whatever they make, they are currently selling for $13 per unit. Variable cost 7 and fixed cost is 6 at the current production level. That means they are selling it at full cost only. Division B, it purchases this product, means same product from an outside supplier for $12. They would like to purchase the product from Division A. Division A will operate at 80% capacity to meet outside customers and Division B's demand. What is the minimum price that should be charged? Understand this question. They are telling there is a Division A of the company that is currently operating at only 50% capacity. Let's say if total capacity is 10,000 units, they are only manufacturing and selling 5,000 units, 50%. The selling price to external customer is $13. And they are also giving the breakup that variable cost per unit of making the product is $7. And the fixed cost that is allocated. Remember, fixed cost has to be covered by all the units produced. So whatever is produced is $6. Now they are telling Division B. Currently, it is buying this product only from an outside supplier, or it can buy. At what price? $12. They are telling if Division A decides to supply to Division B, then also it will operate only at 80% capacity. Means right now the total capacity is 10,000. I'm manufacturing only 50%, 5,000. If I deliver to them also, I will only be operating at 80%. So no additional fixed cost will be incurred. And they are asking what is the minimum price given this situation. The minimum transfer price is always the relevant cost. Relevant cost always says variable cost per unit of manufacturing plus any avoidable fixed cost plus any opportunity cost. Variable cost per unit is given in the question, it is $7. Now, because I will still be operating only at 80% capacity, even if I accept Division B's proposal, I am not going to incur any additional fixed cost, so avoidable fixed cost is zero. And because I don't have to cut down on any external sales to meet this demand, I'm still not operating at full capacity. So opportunity cost is also zero. So minimum transfer price is the relevant cost, $7. Transfer pricing is one of the easier topics in section C. Students more often or not get confused because they are not clear with their concepts on what is relevant cost. If you cannot identify relevant cost, that will be a problem. Otherwise, this is a very easy topic. Question 4. It says plastic division, which is a profit center. So it is telling there is a division of the company, plastic division, and it is a profit center. It is selling its product to external customers, outside customers, also to internal profit centers, others within the company. Which one of the following circumstances would justify the plastic division selling a product internally to another profit center at a price that is below the market-based transfer price? So what they are telling is there is a plastic division in a company. It is selling to outside customers its product and also to internal divisions. And it is operating as a profit center. So they are asking what of the following 4 situations would justify the price to be below market price if any cost can be avoided. Routine sales commission and collection cost would be avoided. Makes sense. If commission is not paid, relevant cost should be low because commission is a variable cost. It's a relevant cost. So yes, it justifies. Profit center managers are evaluated on the basis of income, then it does not justify at all. If my performance evaluation is on the basis of profits, I am not likely to sell at below market price. मुझे अपना भी तो देखना है ना भाई. So B is not correct. Buying unit has excess capacity. Why do I care what buying unit has? If selling unit had excess capacity, I would have considered. Buying unit has excess capacity, let it be. If I don't have excess capacity, I'm losing opportunity cost. Na? C also cannot be the answer. Selling unit is operating at full capacity. No, in this situation, always market price. Because if I'm operating at full capacity to give to any other division within the company, I will have to cut down on my external sales and I will lose contribution on it. So I should generally sell at market price. So only A is the correct answer. Because if I can avoid this sales commission, my cost automatically falls. Since sales commission is a variable cost, and if this is not incurred, and collection cost can be an avoidable fixed cost if it's a fixed salary, if commission incentive, then variable cost, it can be saved. So yes, this situation justifies. So understand or try to understand the topic that transfer pricing mostly speaks about what is the minimum price or maximum price that can be dealt with, because most of the companies have this policy that their division should operate as profit centers. Most of the time the transfer price should be relevant cost. If it's a negotiated, somewhere in between. So that's it for this session, guys. We'll see you again in next session with perhaps a new topic or some more MCQs on a different topic. Till then, have a good day, everyone. Thank you for your time.